Hello and welcome to this special episode of the Mutual Fund Show. Often we talk about the best equity mutual funds that you should consider investing in. And we also talk about the importance of having a well-diversified portfolio and why you should invest in fixed income as well. But we don't talk enough about the opportunities in fixed income. Often you think about these investment products as giving you steady returns, but there are factors at play that could boost your earnings from fixed income funds. With the Federal Reserve in the US having already cut rates, it may be the turn of the Reserve Bank of India next week. That's good for investments into bonds. How much do you stand to gain if you consider investing right now? To talk about the context and what you should bear in mind, I'm joined today by Jayesh Mehta, who is VC and CEO of DSP Finance, as well as Devang Shah, Head Fixed Income at Axis Mutual Fund. Thank you so much, gentlemen, for taking the time. Let's set the context then, because we're days away from the next meeting of the Monetary Policy Committee of the Reserve Bank of India, and there's a lot that's playing out globally as well, which may finally nudge the RBI to cut rates. I'll start with you, Jayesh, first. How would you describe the situation as it stands right now?
So there are two ways to look at it. Of course, one is my own individual personal view, what they should be doing, and second is what I expect them to do. So from expectation point of view, with the statements in last 3 months, I think we would be still status quo on the rate in this policy. Maybe in December policy, we may see a rate cut or something like that. But at the most, you may see some stance change in this policy. But beyond that, I don't really see anything happening in October policy. Of course, there will be always 5% surprise element to it. But otherwise, nothing expected at this juncture. My personal view is they should do it, irrespective of Fed or not, because the core CPI has been pretty low. Even with the CPI headline and expectation, you still have 2% real rate. But of course, so they should be doing it in this October, but I know they won't be doing it because of all the reports which we have been reading in last 3 months by governor or the speech and all that. So it doesn't look like happening. But nevertheless, it's if not October, December, or February, we definitely look forward for a rate cut. And then I do expect RBI will do it mostly in December. If not, 10% chances in February, but 90% chances they will have a rate cut in December.
Okay, fair point. Devang, I want to come to you next. Before I get into your reading of the context as it stands, for the benefit of my viewers who are also investors into mutual funds and into, therefore, fixed income investments in mutual funds, ordinarily, how do you describe the possibility of capital gains when there is a 100 basis point fall or 50 basis point fall? How does that translate into earnings?
Well, yeah, so thanks for inviting us. And to answer the question specifically, SEBI has done a very good job of classifying debt mutual fund categories as per their duration horizon. So we have a fund which you can invest only for 1 day, which is the overnight fund. And you also have duration funds like short funds, medium-term funds, or long duration funds. And there are specified duration mandates. Like if you look across the short-term category, they have something like 1 to 3 year duration. Typically today, as the other speaker explained, that all of us are expecting rate cuts and we are quite bullish on the rate cut cycle. Today, broadly, everyone will be running closer to 3 year duration. The other category is medium term, where probably the duration is between 4 to 7 years. And the third category, which is long duration funds, typically are run closer to 7 to 10 year duration. As the question was that probably you see 100 basis of rate cuts, depending on the duration which the fund is running, a short-term fund, which is typically running around 2 to 3 years, probably you can get a 2% capital appreciation. Similarly, when you look across at a medium-term fund, you can get somewhere between 3 to 4. And if you're looking at a long duration fund, which is running closer to 7 year duration, can get a 6 to 7% capital gains. This is in addition to the carry or the yield of the fund. So typically a short to long duration funds will typically have carry between 7 to 8%. And at a 7% carry, you add the 2 to 7% capital gain, the returns for mutual funds with 100 basis rate cuts, depending on the duration, can be significantly better.
Yeah, that's a fair point. And thanks so much for explaining that in such detail. Let's get to the context then. And we've got Jayesh, who's already pointed out that he doesn't expect that there will be a rate cut. But I want to first zoom out and talk about what's happening across the globe and whether that's going to have any bearing on us at all. You saw the Fed cut rates last week. There's expected to be another 50 basis points cut in this year itself, calendar year. And they're trying seemingly to engineer a soft landing. Will that have any bearing on us at all?
So that's question.
Yes, Devang, that's for you.
Yeah, so our perspective is, Alex, yes, I completely agree with Jayesh that somewhere down the line, our thoughts are similar with the 100 basis of rate cuts, probably from Fed. And you rightly pointed out, I think next year also, I think markets have started pricing in another 75 to 100 basis of rate cuts. So if we look across it from that perspective, when I dwell on the local macros, specifically on inflation, we will be undershooting RBI's expectation on Q2 and on an overall perspective for Q3, Q4 perspective. Q2 expectations for RBI has been 4.4%. Our estimate shows that inflation for the quarter will be sub 4. Q3 and Q4 again, probably thanks to good monsoons, and we are not seeing any significant spike in commodity prices. In fact, the weaker China data supports a weaker commodity trend, which gives us more confidence that inflation will be lower than RBI expectation. In that context, where GDP is peaking out, inflation is lower, stable external sector, we believe there is a very high probability of RBI to start rate cuts in second half. Our assessment is October onwards, every policy is live for a stance change, and we are expecting a 50 basis rate cuts till March 2025.
That's an interesting perspective. I'm actually curious, Jayesh, what you think about the yield curve as it stands right now, because I was looking at the 10-year yield. As things stand right now, it's close to 6.85 or 6.86. And we have repo at 6.5. How much of the expected rate cuts are already priced in your opinion?
No, so it's like this, when your next cycle is going to be a cut, right? So irrespective of when, like whether it is October, December, February, when your next cycle is cut, repo and this maybe a 25, 30 basis point is quite justified because you're not really expecting a next cycle to be a hike or anything. So if it is a cut, a 20, 25 basis point differential is very much justified for the on-the-run bond. Of course, off-the-run bonds, you will get some 5, 7 basis point kicker there. So that's perfectly justified because whenever you get the next, because, your upside, downside kind of, there may be some technical something in between, demand supply mismatch, whatever it could be. That could be your downside could be not more than 3 to 4 basis point. Whereas when you actually see the cut happening, maybe in October, December, February, whenever it happens, right? That whole thing can shift to maybe repo was to another 10, 15 basis point from here for 1 quarter point cut, and maybe another quarter point cut. It can really substantially change. So that's where you see some appreciation, and that's what are we completely comfortable. See, it's just cycle where you are in. If the cycle is flat, if the next cycle or next expectation is a hike, then maybe 60 basis point over repo would justify that. But as of today, we are in a different cycle.
Yeah, that's a fair point. Devang, I want to get your view on this as well. Pretty flat rate curve as it stands right now. How do you see it developing? As in, one would assume that it will change. Jayesh seems to think that 15 to 20 basis points is possible if there is a 25 basis point cut and another move. But can you quantify what your expectations are?
So, yeah, I think he explained it quite well, and probably I'll just add a couple of things. So, Alex, all of us know that probably the rate cuts, and specifically the longer part of the curve, which is duration assets like 10-year and all, they start pricing in expectations of rate cuts. So, like in equity markets, we start pricing in the next 2-3 years of earnings. In debt markets also, we probably price in the next 12-18 months of rate cuts. Yeah, the other point, which is I think probably very important, is large part of the rally in long bonds happens in anticipation. So if we are expecting 50 basis of rate cuts, market will start pricing in somewhat partially a part of it, and probably then once the rate cut cycle starts, you see the next leg of rally. Also, I think what is playing very favorably for Indian bonds is the entire demand supply dynamics. I think we have seen a significant growth in real money AUM investors, which is the pension, provident fund, and insurance companies over the last few years. The AUM has almost doubled since March 2020. The another important aspect is that FPI buying in India has been very strong. We have seen year to date more than 1 trillion of FPI buying, which is also supported and leading to this spread compression. Our assessment is that in a rate cut cycle, previously also we have seen these trends, the spread can compress to 15 to 20 basis. As highlighted, I think probably once the rate cut starts, it will get reassessed or the spread will get readjusted to closer to 50 odd basis.
Okay, interesting. Jayesh, I'm coming back to you just to give some perspective on where, according to you, should investors be in this current yield curve in order to take the best advantage of the potential rate cuts. As you've pointed out, we're at the end of one cycle and the beginning of another. To a certain extent, some amount of the rate cut expectation has already been priced in, so some advantage has already been lost. But where would you position yourself if you were to start now?
So, the probability, confidentiality is much, much higher, right, of a rate cut. And in that situation, because you talk about investors, so when you talk about investors, they can come, they are not really, they are more of face value player. Even if they come through mutual fund, they are a face value player. So in that particular situation, I would like to keep the highest duration possible, right? Because that's where I get the capital appreciation the most, when it is in the highest duration. What happens for traders and banks and all that, for them, it's a very different situation because their limits are based on PVO1 limits, and therefore they can have this, they don't have much constraint on the face value, but they can manage the risk. For them, I would still prefer 2023, 38, some illiquid bonds, which still give you 6-7 basis point kicker, 5-6 basis point kicker. But otherwise, for investors, definitely the longest duration bond is something they should definitely look at.
Yeah, I'm curious about how you're constructing your portfolios, Devang, as things stand right now. What is the kind of duration that you're picking? What is the sweet spot according to you?
So I think completely agree. I think probably our assessment is also similar. I think, yes, you highlighted the right point, Alex, that a large part of the rally is behind us. So now, if you look at it from year to date, we are probably were at 730.35 at the beginning of the year. Probably now we are trading at closer to 675. We've already seen 50 to 60 basis of rally. We believe that in this cycle, we would have seen closer to 75 to 100 odd basis. So we are now playing for the last 25-30 basis. Our perspective is, yes, investors are again freshly looking at allocations in debt funds. They should probably look at short to medium term funds and allocations to long duration and gilt funds. So these are the 3-4 categories which we are advising. The long duration and gilt funds are more for investors who want to ride the interest rate cycle. The short to medium term funds are more for investors who want to lock in yields at the peak of the interest rate cycle.
Yeah, that's a fair point. Do remember, of course, that all gains from debt mutual funds are now treated as short-term, irrespective of how long you hold it for. That change has been made. It was made before the more recent changes to the capital gains structure. And so therefore, if you do choose to invest in a mutual fund right now, in order to gain the benefit of a fall in interest rates, you will have to pay slab rate on any gains that you make. And that includes the coupon or the yield, as Devang has pointed out, or the carry that Devang has pointed out, and any potential capital gains that you make. Jayesh, I want to come to you on where you see opportunities in credit, if at all. I'm just curious because I want to take this question to Devang as well. As a category, credit risk funds have been kind of, how do I put it? It's been a stepchild almost treatment ever since you had a bit of an issue in terms of one particular issuer. And it's not changed. But do you think that the quality of paper that is being issued by Indian corporates has improved and that there are opportunities to be had in that corporate credit space?
There are two parts to it, right? So, one is the liquid credit, which is again like your AAA bonds, like your NTPC, IRFC, or a Reliance. Basically, a AAA bond, which is more a surrogated interest rate trading with a little bit of, markup or spread over the government securities. So that is one side of it. So I would not really sell them as a credit kind of thing. But yes, there are AAA bonds, which are pretty good. Now, unfortunately for us in India, we haven't seen large issuance of that coming in for a period of time, at least in the last 5-6 years. We don't really see large manufacturing, AAA corporate actually coming and issuing bonds, but that somehow is missed out. Of course, when the credit funds were launched 5 years back, or when we had this problem, that was more bound to happen, because when you try to maximize yield by structured credit or private credit, if you really look at private credit per se, it's not as liquid as government bond or even a AAA corporate bond, or to that matter, your large cap equity shares, right, or equity markets, right? It's not that liquid. And to have a daily NAV on the credit fund is a little bit difficult. So that's where the problem was. I don't think anybody lost money when the debacle happened. Everybody got their money. It is just a question of timing. That's where because if it is tightly structured, it's tightly managed, you won't get money, but there is a timing issue because of your daily NAV. But it is good part what has happened now, the credit funds which have come, they don't have daily NAV, they have monthly, quarterly, or maybe a lot of them actually have a lock-in kind of situation. So that kind of gives you much flexibility, and that's where we are seeing a lot of growth happening.
Yeah, interesting. Devang, when you construct your, and we spoke about this not too long back, I believe, but I think it is important to reiterate. If I remember correctly, that conversation unfortunately was interrupted because of breaking news. So let's delve a little deeper into your portfolio of credit risk fund. If I remember correctly, you had only one A- rated paper. And I don't have the screen in front of me, but if I remember correctly, most of your paper was AA and be above AA, right? So even in a credit risk fund, which is supposed to take a little bit of credit risk, you're tended towards better issuers, safer paper. Is that the case across the industry?
So as I try to highlight certain things, Alex. So first of all, I think the avatar on credit funds have massively undergone a change since the 2018-19 crisis. I think probably SEBI has come out with significantly better norms on the liquidity of the fund. We are now maintaining a certain percentage into liquid assets like an SLR or CRR, which a bank maintains. Every fund has certain assets maintained in government bonds, AAA assets, which is a mandate from a regulation perspective. Secondly, what has also happened is somewhere down the line, last 2-3 years, as the view probably has been more positive on rates, specifically since the rate hike cycle. And if you look at now, it's been like more than 8-12 months where RBI has been on a pause. We have all built in duration assets. So it's also because of the macro reason where the credit spreads had massively compressed. Thanks to a very positive cycle post-COVID, we have got very, very good growth. Balance sheets have gone significantly positive they have got significantly repaired. You have seen the lowest leverage, lowest NPAs. So with that criteria, credit spreads have gone through a massive compression. At the same point of time, the duration trade started becoming much more attractive. So yes, today, a lot of credit funds are holding duration assets, lower percentage of single A and AA assets, and they have tilted a portfolio more towards quality, where they can capture the interest rate cycle, probably give benefit to the investors to make those returns. But I think, as we all know, that these rate cut cycles, unless and until we see accidents in US or in India, probably the rate cut cycle would be very, very shallow. With that perspective, I think the next theme would be to build in credit assets. The economic cycle is still strong. So our view is today, yes, the percentage of single and AA assets is lower, but the next theme would be to build up those assets at an attractive spread.
Okay. Jayesh, I'm just curious. I'm going to toss this to you, but if you don't have a specific view, I will completely understand. We were recently reading credit default swaps now made available to mutual funds. Do you think that is going to change the game in terms of the ability that mutual funds have to take on a little more credit risk? And would you be able to explain why this would be a big deal, credit default swaps?
So before I give my thought process, I just wanted, since Devang is here, I wanted a clarification.
Sure.
Devang, when a mutual, in the new guideline, in the mutual fund, when you write a credit default swap, right, you need to have that cash invested into liquid, right? Is my understanding correct? Because I'm not really going through the detail of that.
Yes, yes. So today, sir, we were always allowed to be buyer of protection. Now we can also write a CDS where it can be seller. At that point of time, we need to maintain liquid assets. Your reading is perfectly correct.
Yeah. So that's where my challenge is, on the credit default swap. Because if you really look at it, like, we have been started asking credit default swap in 2003, right? At that time, the situation was different. Foreign banks had credit risk appetite. They didn't have funding. Right? They were borrowers, largest borrowers in the call money market. They didn't have deposits. They didn't have funding. So therefore, their credit was acceptable, right? So when a foreign bank is writing a credit to you, your protection to you, you are comfortable, on the credit risk. So that's where the game was. Now, today, what has happened is, even in the interbank, they tried. Today, most of the banks, whose credit, whom you are comfortable with, right? That guy has no problem in funding it. So why would I just write the protection? I would rather buy the credit myself and earn the entire thing, right? Why only my, protection margin? I would rather earn the whole spread because I do not have liquidity problem. Having said that, yes, it is a tool which is required, but globally also after Lehman, what you mostly see, because one can say you can do it through a CSA, mark-to-market margin and stuff like that. But the problem, unlike rates and FX, where you can have a credit support annex, you can do mark-to-market margin because volatility is like kind of defined, kind of limited, right? And therefore your margin can be done on a daily basis. Credit is sometimes 0-100 game. It's not always 0-100, but whatever margin you are putting up, if there is an event, if there is a credit event, you can lose 40-50% of the value, and that no amount of margin is gonna help that. So yes, it's I think we are trying to help the market. We are trying to make it enabler. I think unless you have an index, because globally people have now moved to credit default swap on an index basis.
Right.
Because on an index basis, if one credit goes to zero overnight, the mark to market is manageable and therefore you can exchange the margin, right? Now here, when it is like the swing could be overnight, it is not going to happen every day, but when it happens, overnight it falls 40%, right? What kind of margin will make it safer? And therefore, my counterparty credit risk is very important to me. And therefore, my counterparty credit risk, which is acceptable to me, he has no problem funding it. So I really see that little difficult. But
let me get Devang to weigh in on this, because I understand that this has gotten a little technical and a lot of people are not going to be able to understand this. Jayesh Mehta, you've tried your best to explain this, but then unfortunately for the retail audience that does not understand credit to begin with, credit default swaps would sound like absolute Greek to them. But to put things simple, Devang, from the perspective of a fund manager, is it going to change your life at all?
So I think yes, it's definitely a big enabler. But at this point of time, the liquidity in credit default swap markets is almost zero. So I think yes, we'll probably develop it over the next 6 to 12 months. As I think Jayesh bhai highlighted, there are certain initial nudges which we all need to resolve. But overall, I think it is a step to from a longer term perspective to better the corporate bond market liquidity. But I think it is at a too early stage. We'll have to develop it over the next 12, 18, 24 months.
Okay. Last closing comments, gentlemen, and then I'll hopefully I'll get some of my viewers to ask me questions and maybe we can touch base later to get them answered. from your perspective, Jayesh, at this juncture, we're talking about the ability to gain, but there's also the potential of loss. Capital loss exists in fixed income. Do you think it's important to understand that concept as well? And what are the risks that someone should bear in mind on duration?
So definitely, the risks are always there. Any market instrument, you will have risk, right? So hypothetically, I'm just saying hypothetically, global geopolitical events happen. The most vulnerable thing for us is crude prices, right? If it shoots up to 130, 100, 120, it could happen. I don't know. Of course, you go with probability that it doesn't look like, but then can it happen? Yes, it can happen if there is some Middle East tension, some other tension. So for us, the vulnerability is coming from that side. Also, because of geopolitical supply chain event which happened, which kind of we faced it during pandemic. It was supply chain driven inflation, which can also happen. So it's all the things, inflation, some cyclone on the food side, and all this stuff, climate situation are definitely risk, and therefore the rate decision always will depend on inflation. So anything which is impacting your inflation forecast, right? If that gets damaged, and then we see that inflation is rising, then you may actually see the rather than cut, you may actually see sudden hike also. In that situation, you would actually have that kind of losses too. It's the same thing if you have a 10-year duration with 100 basis point, you can actually lose 10%, right?
Yeah.
So that's the kind of situation.
Yeah, it's a fair point, and well put. Thank you so much, Jayesh, for laying that out. Jayesh, Devang, thank you so much for joining me on this edition of the Mutual Fund Show. Absolute pleasure having you. Well, we've tried to lay things out for you, and we've tried to give you the pros and cons of investing in fixed income mutual fund scheme beyond the obvious. And hopefully this has been useful for you. If you've got questions for us, make sure you write them to us on that number that you see on your screen. And do stay tuned, lots more coming up on NDTV Profit.